Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get to the headlines. Nifty is back above the 12,000 mark as 8 out of the 11 sectoral indices trade in the green.
Automakers failed to gain traction in May, with all players reporting a drop in sales. Bajaj Auto the only exception.
Back home, India's GDP growth fell to a 20-quarter low in the first 3 months of 2019, prompting calls for another rate cut by the MPC this week.
Finance Minister Nirmala Sitharaman will have to address these issues when she presents her budget, her first one on the 5th of July.
The US revokes India's designation as developing nation, impacting exports of nearly 2,000 products, which did not attract any duty in the world's largest economy.
We'll get to that. A quick check on how the markets have opened this Monday afternoon. Agam is here with a quick check of some of the stock movers.
Right, Harsha, there are two things that are driving markets today. First one is the auto sales, and the second one is, the drop in crude that we've seen off late in the last 4 sessions. For now, the benchmark indices are advancing by around 0.8%. That's the case for the Nifty and the Sensex, and the banking index is just a step behind, but that's still also trending in the green. And in terms of the turnovers as well as the volatility index, at least coming down to your volatility index has come up further. Your turnovers have relatively average levels at around 4.5 lakh crores right now, so not too much to speak for there. Again, on expected lines, considering we were expecting a decline in volumes once we were done with the big update last week. That said, when it comes to the sectors which are driving the markets, the first one is the auto sector. Yes, auto sales have been weak on a year-on-year basis for the month of May. However, a lot of these volumes numbers for the month of May are coming out and turning out to be better than what the street is working with, which is why a lot of these auto companies are advancing in trade. Some of these, of course, include something like a Hero MotoCorp, Bajaj Auto, and these two-wheelers essentially are what's driving the markets upwards. Besides these, we're also looking at an upward move in some of the OMCs, which will include Indian Oil Corp, which is doing well, considering we have seen a 13% drop in crude oil prices over the weekend. What, however, is not doing so well at this point in time is counters like Tech Mahindra and ITC to a certain extent, and we are looking at some amount of weakness in something like an Eicher Motors, where there has been weakness, but all in all, we're looking at a relatively steady day today.
Thanks so much. There's a lot riding on June for Indian automakers. Monthly sales growth refuses to budge from the negative territory. Almost all players said consumers were waiting for elections to get over before buying new vehicles. Yatin Mota is here for more.
As expected, it was a weak month of May for most of the automakers. And starting with Maruti Suzuki, wherein we saw the highest percentage fall in the month of 2019 when it comes to the percentage change year on year. A 22% decline is what we saw for the month of May for Maruti Suzuki sales. Their small car and mini car segment sales fell 25%, and a similar fall was registered as far as the domestic markets are concerned. However, Chairman R.C. Bhargav, when he spoke to Bloomberg Quint, he was hopeful that from August we could see some strong growth coming in for the car volumes. Also, we had Mahindra & Mahindra, wherein not only the tractor sales fell by 16%, but also a 3% decline was seen in the auto sector for Mahindra & Mahindra. Of course, this is despite the fact that the new Marazzo and XUV 300 are doing well in the marketplace, which are the new launches from the auto segment for Mahindra & Mahindra. Tata Motors also reported a weak set of monthly sales numbers. The total domestic May sales were down 26%, and look at the tipper and the medium and heavy commercial vehicle sales. They were down 22% as well as 38% respectively, and the domestic passenger vehicle segment also saw a decline of nearly 38%. Escorts, SML, Isuzu, Atul Auto, these are the smaller companies which reported again a muted set of numbers. Of course, there was some growth seen for SML Isuzu, but that comes in on the back of a smaller base. Eicher Motors, commercial vehicle sales were down 20%, but Royal Enfield, since the festive season last year, we have seen a continuous amount of fall coming in for Royal Enfield business. This time, the sales in the month of May were down 17%. Of course, Ashok Leyland came out with numbers. Bajaj Auto also came out with numbers. Marginal, growth seen there. but still, more or less in line with the expectations. All of the stocks in the auto segment have been recovering from the day's low in the hope that there could be a RBI cut in the next few days or so, coupled with probable buying ahead of the BS6 implementation.
Yathan, thanks for that. Auto sales is just one indication of the slowdown in the economy. GDP growth was the slowest in 5 years in the fourth quarter of the last financial year, and this was mainly due to weaker consumption and investment. This has prompted calls for steeper cuts when the Monetary Policy Committee meets this week. All eyes on how the new finance minister addresses those macroeconomic concerns when she presents the budget in early July. To discuss the policy options before the government and the RBI, we're joined by Upasana Bharadwaj, senior economist at Kotak Mahindra Bank. Upasana, thanks so much for joining us. First, let's begin by asking you about, what did you make of the headline GDP number? Where do you think are the weak spots?
Yes, of course. We were expecting the fourth quarter GDP at 6%, and it came in even slower than that. Clearly not a very encouraging number. And the breakups also suggest that it's both the consumption and the investment which has led the slowdown. And I think, if you look at most of the high-frequency data and even the corporate earnings, as a matter of fact, I don't think the next few months are also showing any signs of recovery. So going ahead, I think 1 to 2 more quarters, we will continue to see growth more or less closer to 6%. And it's probably, in the second half of the year, because a piece of the slowdown is also probably because of election-related uncertainty. And I think that could probably, gradually fade off, and we should start seeing some kind of a recovery, especially in this investment sector towards the second half of the year. And also, if monsoons were to pan out, hopefully in the right way, then we may see the rural demand gradually pick up. Along with that, some kind of a rural boost or stimulus that can be provided during the budget will have to be watched out. Of course, the cabinet has already cleared 1 or 2 measures which were earlier in the mandate, in the manifesto of the government. So they have already cleared those rules, and I think we would be seeing some kind of positive fallout of these in the second half of the year. But the near term looks still grim, and I think that does warrant some kind of a policy boost. We will need to see how that really comes about, and it will have to be a mix of both the fiscal and the monetary stimulus. From the monetary side, I think since we have the policy this week, we are expecting 25 basis of a rate cut, with another 25 basis of a rate cut in the following meeting. At this point in time, we are looking at the liquidity being much more important. So along with a 25 basis of rate cut, we hope to see some kind of clarity on sustaining of liquidity in surplus zone for a little more longer period. So some kind of clarity on, or a determinate view on liquidity stance. That would be important to watch out for, because I think that is where we could expect, in part, some kind of transmission. Of course, we know that the issues in the financial sector are not just liquidity constraints, but also the credit issues.
Yeah.
And that, of course, cannot be addressed through just liquidity and the rate cuts. But yes, at least in part, the softness in growth can be mitigated through these kind of measures.
Upasana, afternoon, Ira joining in. Just a couple of sort of fine print of GDP, which then also tells you what policy should and should not do. So I know there was this hue and cry about consumption being weak, and I know that consumption growth has weakened in Q4. But if you look at long run data, quarterly data for the last 2 years, or annual data for the last 5 years, 7.2% consumption growth is not like it's fallen off the cliff. So I just wonder then, has there been a little bit of excessive hyperbole about the fact that consumption is weak in the economy and policy response is required?
No, I think there are 2 parts to this. I think if we look at the rural versus the urban, so there is probably a little bit of deviation there. It is a certain segment which is probably under more stress compared to, and I would say rural is probably under more stress. And more so, if you look at the high frequency data, they are further suggesting more and more slowdown. So it is not just about the fourth quarter data, but it's also about what lies ahead. So yes, the slowdown, if on a standalone basis 7% growth does not look as weak, but the point is, will we be able to even sustain that 7% is a question. And I think with the impact, the lagged impact of the financial tightness that is there in the system, we might continue to see this problem if some measures are not taken. So hence, we do not require really a bazooka, but at the margin, certain measures would be required to address those specific issues which is plaguing the economy. And like I mentioned, there is a problem of financing to the smaller and the medium enterprises that could eventually, require some kind of a policy initiative to support that segment. There is a problem at the rural side, which could again come about through policy initiatives. So maybe a sectoral focus becomes much more important than a much more broad-based stimulus.
Sure.
And maybe, we'll have to look at those segments. Now, if I look at the demand side indicators, actually, yes, the auto segment is doing extremely weak. We are looking at, if I look at the real rural wages,
yeah,
that's
no, I get
still
that.
not as bad.
I totally
So
get that the rural problem is there, Upasana. I think my question, and you answered that do we have a demand problem more broadly? I guess the MPC will look into that. The investment part was also interesting. I know there could be one-offs built in here because of pre-election uncertainty, etc. But surely, if investment was supposed, was moderating so quickly after it picked up, that's something that the MPC wants to consider. We all know that one member in the MPC has been harping about the fact that real rates are too high. We haven't seen the broader MPC take cognizance of that.
Yes, I totally agree. I think there is a lot of consensus building up that the real interest rates have been high, and probably that is another factor which is constraining. But we know that cost of borrowing is not the only factor which really is constraining investment. One of the factors, as we pointed out, was, of course, election-related uncertainty. The other is also, I think, the lack of animal spirit which is there, which is the lack of demand, consumption-related demand. So when the visibility on demand is not there, the investment cycle automatically will take a backseat. So I think, the nascent signs of pickup in investment that we were seeing in the past few quarters, that probably took a backseat, one, because of election uncertainty, and two, also because demand indicators started showing significant signs of weakness, and that is where probably we started seeing a pullback on investment. Of course, we should not forget that capacity utilization, whatever data we have till December, at least has been picking up. So that is not yet as bad. But if you look at the capital goods production in the industrial production data, etc., then that is not, of course, encouraging. So I think we should start seeing stabilization. We should start seeing some kind of stability in the next few months. But it will we still probably will be in this period of consolidation before we can start seeing some improvement.
Sure. Upasana, just last word. If we do get a 25 basis point cut, and everyone seems to be expecting that, but we don't get any sort of clear guidance on how they intend to approach liquidity, you think there'll be disappointment in the markets? Yields have come off significantly. We are trading below 7 today. So markets seem to be building in something apart from all the global factors, of course.
Yes, I think the way markets are going, we know that it was a very weak GDP number, and also along with that, crude oil prices have helped over the last 1 week. So both these factors taken together has obviously provided cheer to the bond markets, and now they're looking at a more than 25 basis. So probably accommodative stance is what markets are pricing in, and of course some kind of clarity or some kind of a clarity on liquidity framework that they're looking at. And yes, if it was only a 25 basis cut without an accommodative stance, without any clarity, otherwise on how they plan to address the issues, then I think there will be a little bit of disappointment in the markets.
Upasana, we leave it there. Thank you so much indeed for joining us with your perspective. Upasana Bharadwaj from Kotak Bank. A flight to safe haven assets amidst rising trade tensions between US and China has led to falling bond yields across the globe, especially the United States. That's according to Johanna Chua, Chief Asia Pacific Economist at Citigroup Global Markets. Listen in to that slice of that conversation.
There's this global demand for safe assets now, very high risk aversion because of the uncertainty. And so part of the yield curve could be a reflection of expectation about the future trajectory of U.S. economy, which doesn't look good. And part of it is just kind of a reflection of the dearth of global safe assets. And people are all looking for some safe assets to hold, and that's driving demand for U.S. treasuries. So I think it tells you we're not in a very healthy environment. I think unless we get some positive break going into the G20, that's obviously going to be key. But I do want to warn, I do think people maybe have been too aggressive in expecting the aggressiveness of Fed easing. At least we're not there yet. There are still some underlying resilience in the U.S. economy. And again, we'll have to see how the negotiation goes on. I mean, we don't want to give up completely that there's going to be no deal at all in the U.S. and China. Maybe it's not going to happen in G20, but the more pain that is felt by both sides, and hopefully the softening of position may surface, even a partial deal may surface. Of course, we will never expect a full deal.
That's a view from Citi. U.S. President Donald Trump opened another potential front in his trade war on Friday. His administration terminated India's designation as a developing nation. This means India would no longer be exempt from duties in exporting nearly 2,000 products to the U.S. Trump said, and I quote, that India has not assured the United States that it will provide equitable and reasonable access to its markets, and hence it was appropriate to terminate India's preferential treatment with effect of 5th of June. India responded by saying that it was unfortunate the U.S. did not accept the resolutions it had offered during bilateral trade talks, but maintained that its trade decisions would be guided by its own development imperatives and concerns. What does this mean for India's exports and the relationship between the two countries? Raj Balla, a Brinda's distinguished professor at Kansas University, had this to say.
The total trade value of GSP-covered goods was about $5.7 billion in 2017, but the actual trade savings in terms of tariffs was only about $260 million. And indeed, the margin of preference, that is the difference between the average U.S. MFN tariff and the zero duty under GSP, is quite small. And it's sometimes said that really GSP is an asset of diminishing value because of that small margin of preference. And I don't think a great nation like India was staking its future on forever, if I may say, milking the cow of the GSP. I'm smiling because I think this is one of the greatest opportunities that India has since its independence to distinguish itself from China and also to develop the strongest relationships with the United States that it has had since independence. And let me explain why. First of all, India's got some sectors that can really benefit from the Sino-American trade war. In an excellent October 2018 paper by the Indian Institute of Foreign Trade in Kolkata, the authors very cleverly identified the merchandise that is subject to the Section 301 tariffs that are coming out of China, and compared them to the Make in India merchandise that are, of course, not subject to those tariffs, and identified several key sectors, including, for example, iron and steel, aluminum, electrical machinery, railway and locomotives, aircraft, spacecraft, many areas in which India could prosper and benefit from the now 25% tariffs that have taken effect on Chinese goods. And then we all know the story also that Apple and Samsung will be making more smartphones in India and exporting them to the U.S., whereas if Wave 4 tariffs go on against Chinese products, and I suspect they will sometime in the next few months, India will benefit from the smartphone exports to the U.S. But I think there's another piece of this, too, where India can really distinguish itself. And again, this is the optimistic story. And that is India's willingness as a democracy to understand and accept its own shortcomings. Look at on the one hand, at the rhetoric coming from the Chinese, the People's Liberation Army leaders this weekend in the Shangri-La in Singapore, compared to the rhetoric coming out of the new Indian government. India appreciates that it has higher MFN duties. It's got a market access problem. For example, its overall average tariff rate's about 13%, whereas the U.S. is 3.4%. That's something India can work on. India knows it needs more FTAs. India knows it can join in some sectoral agreements. But in contrast, the U.S. relationship with China is much more fraught with denial. And the U.S. would sometimes say deception from the Chinese side. I think this is just a great opportunity, substantively and stylistically, for India, again, to really show it is different.
Nearly 4 years after India's lenders started a grueling bad loan cleanup, stressed assets appeared to have started to decline, although at a moderate pace. Recoveries under the bankruptcy code, a slower build-up of fresh bad loans and increased write-offs have helped. Advait joins us with a closer look at the numbers that have emerged from the fourth quarter earnings.
Yeah. So out of 37 banks, we analyzed the financial results for around 35 banks. We found that the gross and NPA numbers have come down by about 10% from close to 10 lakh crore last year to about 8.98 lakh crore this year. Now, public sector banks have reported the biggest decrease in NPAs by about 12% from 8.8 lakh crore last year to about 7.7 lakh crore. On the other hand, certain slippages emerged in the year as large corporates such as Jet and the infrastructure leasing and financial services group went under. This also had an impact on the NPA figures reported by 15 private sector banks that saw the gross NPA number go up by a small 2% over last year to about 1.24 lakh crore as of the end of FY19. The bulk of the NPA numbers were driven by the large NPAs figures on the books of Yes Bank and IndusInd Bank over the course of the year.
Advait, thanks for that. Let's move on now. The Boeing 737 MAX grounding could not have come at a worse time, says SpiceJet Chairman and MD Ajay Singh. The budget airline, which is hoping to capture a larger chunk of the market after Jet Airways shut down, has 13 737 MAX grounded right now. Speaking to Stephen Engel of Bloomberg News, Singh says the budget airline's hopeful that planes are back in service by August. He doesn't rule out turning to other plane makers like Airbus if Boeing fails to secure all necessary approvals within this year.
Well, the Indian regulators have visited, much as other regulators have visited the FAA, and I think they will look to satisfy themselves. I think it is for every regulator to find their own level of comfort. But our hope is that once the FAA satisfies itself and once some of the other regulators satisfy themselves, DGCA, our regulator, will too. But after all the scrutiny that this plane has been through, it's clear now that this is probably going to be the safest plane in the world.
I mean, you like the airplane, but you must be frustrated. How frustrated are you? At a time as well when there's, implosions going on in the airline industry. Jet Airways, one of your big competitors, has collapsed. You have an opportunity to strike and get market share, but you don't have your key airplane in the air.
It's extremely frustrating because, as I said, it was a good plane. We were flying it, and this was the opportunity when we could have gone and taken some space and some market share from Jet, and we don't have, as you said, our best plane. So this was also our peak season, the summer season when the traffic is at its peak. So it's very frustrating, but all we can do is hope.
So how do you fill the void then if, like, for example, we heard from Tim Clark of Emirates, he doesn't think that the plane's going to be flying until the end of the year, if not the beginning part of next year, so 2020. You need to fill that capacity with other aircraft. You must be looking at whether Airbus is going to be launching, the A321 XLR. I mean, that's longer term, but what are your airplane mix fleet decisions?
Well, firstly, I hope Tim Clark is wrong. And that plane does fly sooner. But in the interim, what we are trying to do is to take aircraft from Jet Airways. As you know, Jet Airways suspended operations in April, and we have been working hard to try and get some of those planes to start flying. In the last 25 days, we have taken 25 of their aircraft, which have started to fly, and we are taking a bunch more. So we are trying to fill in the gap to the extent that we possibly can using those planes.
Because you have 13 MAXs now that are sitting on the tarmac, but you have 205 more orders for that. So again, are you looking at other aircraft, not just from Jet?
Well, we always continue to look because it's clear that that SpiceJet and India needs many more aircraft. So if the MAX does not come back in a short period of time, of course, all options are open. The first option, of course, would be to look for more 737 NGs because, our engineers, our pilots, our entire system is geared towards the 737. But, of course, we can't rule out the possibility of looking at Airbus and other aircraft.
Can you give any indication what kind of compensation you're looking for Boeing?
Well, at this time, Airbus, of course, is offering us aircraft, more in the medium to long term with their, the 321 series of aircraft, including the LR and the XLR. So we are looking at that. We are also looking at least at an aspirational level at the wide-body aircraft, because there is a space that has been created. India really importantly needs to take its passengers through the world, and Jet was fulfilling a large part of that job. So we are looking to see if there is a possibility in which SpiceJet can fill in some of that gap. It's a tougher thing to try and do. The Jet aircraft are not necessarily in the best condition, but certainly there is space there which Indian carriers need to fill.
Ajay Singh of SpiceJet. Out of time on the show. Thank you so much for joining us.